Hey, if you bought crypto this past week thinking the Federal Reserve ending quantitative tightening was your ticket to easy money, well, you just learned a $600 million lesson about what happens when everyone thinks the same thing. Look, if you're short on time, or frankly, if you're skeptical about listening to some random guy on the internet who talks about finance while making cat puns, here's what you absolutely need to know right now. The next 72 hours, Monday through Wednesday, are going to be treacherous. Do not, and I really mean this, do not try to catch this falling knife until we get confirmation from the data drops on Wednesday and Friday. The real pivot point is Friday's core PCE report. That single number will determine whether we rocket into a Santa rally or we sink another 3 to 4%. Stay patient, stay cash heavy, and I'll explain exactly why in the next few minutes. So, hey there. For those of you who are new here, welcome. My name is DataCat, and no, that's not some crypto bros pseudonym I came up with at 3 in the morning. I'm a former analyst who spent some years working inside a Fortune 50 company. You know the type. Just the average corporate slave who has listened enough corporate jargon. I basically traded my sanity for a stable paycheck and a fancy title that meant absolutely nothing outside of that building. This channel is about 4 months old. Now, I'm not going to sit here and tell you I'm some expert or that I've figured everything out. I'm still learning, still building this thing one video at a time. So no course selling or paywall guarded content here. And here's the thing, I realized there's this massive gap between what Wall Street knows and what retail investors are being told. And someone needs to bridge that gap without all the hype, without the clickbait nonsense, just straight analysis. If you are into this kind of thing, please smash that like and subscribe button for me, it would mean a lot to me. So let's talk about what would happen today, on Monday, December 1st. If you wake up this morning and see red across the board, especially if you're holding any risk-on assets like tech stocks, or, and this is rare for me to talk about, but even Bitcoin, you might be wondering what the heck just happened. Here's the simple version. We are witnessing a textbook sell the news event combined with what's called a massive leverage flush. Now, let me break that down, because this is important. For weeks, the market has been front-running, meaning bidding up assets in anticipation of today. What's today? Today is the official day the Federal Reserve ends quantitative tightening. Now, if you're not familiar, QT is basically the Fed draining liquidity from the system. They've been shrinking their balance sheet, pulling money out of the economy. The end of QT means that drain stops. No more liquidity being sucked out. That's structurally bullish long term. But here's what happened. The market already priced this in. Everyone knew this date was coming. So smart money institutions they bought weeks ago, they front-ran the event, and now that the date is actually here, well, the event is over. There's nothing left to anticipate. So what do? They sell. They take profits. Classic buy the rumor, sell the fact. Now, I don't usually talk about crypto on this channel. That's not really my world. But today, I have to, because what happened in the crypto market is directly tied to what's happening in equities, in your stock portfolio, the S&P 500 or your favorite tech stocks. Bitcoin flash crashed, and I mean flash crashed hard. It dropped to the $84,000 to $86,000 zone. That wiped out $150 billion in market capitalization in a matter of hours. Let me say that again, $150 gone. But here's what you need to understand. There was no news, no regulatory announcement, no hack, no scandal, nothing. This was pure market mechanics. This was a liquidation cascade. Over $600 million in leveraged long positions got completely destroyed. See, here's how it works. Traders use leverage. They borrow money to amplify their bets. Price drops. They get margin called. Forced liquidation happens. That selling creates more downward pressure. Triggers more margin calls, more selling. It's a death spiral, a cascade. Now, why does this matter to you if you only trade stocks? And this is the important part. It didn't always matter this much. See, back in the day, your average crypto trader getting liquidated, they just go broke. That was their problem. They weren't holding a diversified portfolio with Apple and Tesla on the side. But here's what's changed. Institutional money is now in crypto. Smart money, hedge funds, family offices, they're holding positions across both markets. And when these players get hit with margin calls in crypto, they don't just go broke. They have to liquidate something to cover their losses. And what do they sell? Their equity positions, their Apple shares, their Tesla shares, their QQ holdings. That's why the correlation between crypto and risk-on equities has gotten so much stronger over the past couple years. It's not retail degenerates anymore, it's institutions playing both sides. And when one side blows up, the other side bleeds. It's all connected now in a way it wasn't before. Alright, so now that we understand what happened today, let's talk about what's coming. And honestly, this week is absolutely loaded with potential landmines. We have 3 major economic data releases that are going to determine the direction of this market for the rest of December. First up, we got ISM Manufacturing PMI. That's today on Monday right now. This is the first test. The ISM Manufacturing Index tells us about the health of the manufacturing sector. Now, here's the tricky part. If this number comes in hot, meaning better than expected, that sounds good, right? Wrong. A hot manufacturing number reignites inflation fears. Remember, the Fed just stopped draining liquidity. If inflation is still running hot, the market starts to panic. Are they ending QT too early? Is inflation coming back? On the flip side, if the number is too cold, meaning worse than expected, then we get recession fears. Manufacturing is slowing, demand is falling, we're heading into a downturn. What we need is a Goldilocks print. Not too hot, not too cold, just right. In line with expectations. That's the only way we stabilize after today's flush. Second, the ADP employment report coming out on Wednesday. ADP gives us a preview of private sector employment. If this comes in strong, way above expectations, that's another potential trigger for a leg down in stocks and crypto. Why? Because strong employment keeps the Fed in a hawkish position. Higher for longer on rates. That kills risk assets. Third, and this is the big one, core PCE on Friday. This is the Fed's preferred measure of inflation. This is the binary pivot point for the entire rest of December. Let me paint you 2 scenarios. Scenario A, the Goldilocks print. Core PCE comes in line or soft, meaning inflation is cooling. If this happens, you're going to see a rocket ship. I'm talking S&P ripping towards $685 and beyond. Why? Because it confirms the Fed engineered a soft landing. Inflation is under control, the economy is stable, and liquidity is about to flood back in. The Santa rally officially begins. Scenario B, the hot print. Core PCE comes in sticky, meaning inflation is still elevated. If this happens, panic. Bond yields spike, the 10-year Treasury shoots up, and the market realizes the Fed might have made a mistake ending QT. We get stagflation fears back on the table. That's the worst possible combination. In this scenario, S&P smashes down again. So, here's my thesis for this week, and what's usually called the liquidity air pocket. We just transitioned from the anticipation of liquidity that was everything before December 1st to the reality of it. Now here's the thing, I've talked about it numerous times over the past few weeks. The actual flow of liquidity from the end of QT, that takes time. It doesn't just magically appear in the market overnight. It permeates the system slowly over weeks. But the leverage flush, that's instant. That happened today. $600 million gone in hours. So what we have right now is this gap, this air pocket, where the pain is immediate, but the relief hasn't arrived yet. And that makes the next 72 hours, Monday through Wednesday, extremely dangerous. You're going to see bounces. Low volume, perhaps head fake bounces on Tuesday or Wednesday. Do not get baited. Do not try to catch this falling knife. The smart money, the institutions, they're flat or short right now. They're waiting. Think of it like this. You know how cats, we always land on our feet, right? Well, sometimes we misjudge the jump. We slip, we fall, and for a split second we're flailing in midair. That's the market right now. It's flailing, and you don't want to be underneath when it's still falling. But then on Thursday, we would typically see a pre-jobs report positioning. Sellers start to run out of ammunition, the panic subsides. Then Friday morning, we get core PCE. That's when we find out if the floor is in or if we've got further to fall. If core PCE is soft, expect a massive relief rally into the close. If it's hot, expect another leg down, and we're probably testing $660 on SPY by next week. Alright, so let's get into the technical side of things because the chart is telling us a very clear story right now. First, volatility compression. Last Friday, SPY printed the narrowest range in 7 days again. It's a consolidation pattern. The market is coiling, getting ready for a big move. The question is, which direction? Given the macro backdrop, the sell the news event today, the leverage flush, I'm expecting an NR7 breakdown. If SPY breaks below Friday's low of $680.50, that triggers a momentum sell signal. We're looking at a fast drop toward the 20-day EMA. Then there's a volume divergence. Friday's rally to $683.39 happened on about half the average volume. That's a red flag. A true breakout requires volume confirmation. What we saw was a low volume drift into resistance. That tells me institutions weren't chasing. Retail was drifting it up, while the big players were preparing for this exact flush we're seeing today. RSI is sitting at 59. That's neutral territory. It's rising, but it's not overbought. The important thing here is that RSI has room to fall to 40 without breaking the broader uptrend. So we can see some pain this week without destroying the bigger picture. Meanwhile, stochastics are at 83. That's absolutely overbought. The short-term tank is full. It needs to bleed off pressure. And so, the key resistance is $685. That's the recent high. If we break above that on heavy volume after Friday's data, we're probably heading to $690, the 52-week high. On the other hand, the critical support is at $680.50. That's Friday's low. This is the trigger level. Break below this, then we might head to the $671 range, which is the 20-day EMA. This is the first logical bounce target. I'd expect buyers to step in here. So, what should you actually do with this information? Well, if you're already positioned, stay patient. If you're in cash, great. Stay there until at least Wednesday. If you're holding longs, consider hedging with puts or just sitting tight if you're long term. Don't panic sell at the bottom. And if you're looking to enter, do not chase anything Monday through Wednesday. I know it's tempting. You're going to see green candles. You're going to feel like you're missing out. You're not. You're avoiding a trap. Wait for confirmation. Wait for the Wednesday ADP number. Wait for Friday's core PCE. Let the dust settle. Let the leverage casino clear out. Thursday and Friday are your entry days if the data cooperates. If we get soft prints, if we get that Goldilocks scenario, then you look for entries Thursday afternoon or Friday morning. That's when the risk-reward flips in your favor. Look, I know this isn't the sexiest analysis. I'm not here telling you to YOLO into some meme stock or promising you 50% returns by Christmas. That's not how this works. Real trading, real investing, it's about patience. It's about reading the data. It's about understanding the macro environment and positioning yourself accordingly. The Fed put is back. The end of QT means liquidity is coming, but the market needs to clear the leverage casino first. It needs to shake out the weak hands, the over-leveraged gamblers who thought they could front-run the move and get out clean. And here's my cat analogy for the week. You know how sometimes cats will sit absolutely still, just watching, waiting for the perfect moment to strike? That's what you need to do right now. Don't chase the laser pointer. Don't flail around. Just sit, watch, wait. And when the moment is right, when Friday's data gives you the green light, then you pounce. That's it for today. If you found this helpful, maybe hit that like button. Subscribe if you want more of this kind of analysis. I'm still figuring out this whole YouTube thing, but I'm committed to bringing you real value, real analysis, no hype, no nonsense. Alright, DataCat out. Stay safe and stay sharp out there, and I'll see you in the next.